and find out what the mood is like in the market. Anand Tandon of GRG Securities joins us now, and in a bit we'll speak with a technical expert as well. Anand, hi, afternoon. The global market has not been too supportive of late. Do you fear that the next leg of our markets could be downwards because of what's happening across the globe?
It could run either way right now because it depends on what kind of solution the European market and then subsequently the US Fed comes up with. I think there is now apparently an increased likelihood that you will see another bout of money printing going through, and the initial reaction of that will be a higher risk appetite and consequently higher markets, perhaps for emerging markets like India. Post that, however, we've seen that in the last two cases of increase in money supply, it hasn't actually led to any sustained rise in the markets, and I would expect that the same would be mirrored this time as well, perhaps even with a lower beta. So consequently, right now I would think that you may get an upward bias if there is more money getting printed. If not, we do have the sword hanging over the large markets in terms of, for example, the debt limit on the US and the issues that Europe is still grappling with.
Anand, hi, afternoon. So what's the best way to prime yourself for that kind of impending move? Because a lot of people actually missed out on the rally we saw last fortnight. Is this a good time to stay with the market, or do you think because chances are evenly split, it's best to sit on your hands for a while?
Well, the way I look at it is, if you're really investing, you need a margin of safety, and right now the margin of safety is not there because you are trying to guess government policy, and that too, strained economic climate globally. So that's not going to be an easy thing to ask for, especially when you have political and economists not necessarily agreeing on any point. But unfortunately, a lot of investors don't have either the patience or perhaps a mandate to sit out and wait. So you have to find some means of investing. And therefore, if you really were to look at an option where you're looking at perhaps more money supply coming through, then you have to bet on sustained inflation, and you have to bet on the fact that, for example, rural incomes can continue to rise faster than urban incomes because, again, the government has gone ahead and raised prices on agri commodities. So essentially, rural plays on energy, especially in terms of gas, and those that will benefit from a stronger rupee are the sectors that you might want to look at.
Lingering weakness though remains in the banking space, Anand. Does that remain the linchpin, you think, for the next move from the market, and what would you expect to see from there in terms of performance?
Well, I've been actually speaking given that the economy seems to be kind of heading towards some serious headwinds, the fear really is that the NPAs will somewhat rise from here on, and therefore, banking is not the best place to be, especially if interest rates continue to harden. But if you put that in context of what I just said, that money supply may actually be easier, and therefore, even though policy rates may continue to head higher, you may not actually find the interest rates higher in the country. This may not be a bad time to look at it, especially for those banks which have actually had some amount of shakeout already happening for a variety of reasons in terms of their pricing. So, in terms of banks, I would look at it, I think, selectively, especially wherever the fall has been sharpest.
Just to extend Mitali's point forward, Anand, would you loosen your grip on not just banks but on the other rate sensitives as well, autos for example, given the kind of macro pressures that sector is facing?
Well, again, I think in auto you have 2 or 3 different segments. So as I said, if you're really betting on the fact that rural incomes will continue to rise faster than urban incomes, then two-wheelers, tractors, and UV manufacturers are good places to be if you can get the valuation right. I think the most difficult area to be trading right now is the small car market, and perhaps to some extent the truck market, because there may be a slight slowdown there on interest rate concerns.
What did you make of the 2 of the IT numbers that have come out so far, and with respect to this sector, what kind of a performance are you hoping to see from here on?
Well, I think the performance for the mid-size or smaller companies is likely to be better simply because of the fact that they are smaller, and given that there has been a sharp recovery in the sector, they are likely to report better numbers for the year that's just gone by. I think going forward, the situation to me looks a little more challenging, though the commentary obviously seems to suggest that there is enough demand. I think my view is that commoditization of the sector is going to be much faster than we've seen in the past, and therefore there will be some margin contraction between the larger and the smaller players, which will of course be offset by the fact that if there does become some slower demand growth, the smaller players find it more difficult to get business. But overall, if you get to a situation where there is slight slowdown in terms of demand and consequently lower margins, and add to that the fact that the rupee may be stronger at least in the near term, then there isn't that much left in that sector vis-a-vis the valuations that already prevail.